Hello, and welcome to Tomversations, a regular conversation with me, your host, Tom Hollingsworth, on a variety of topics related to enterprise technology. Today, I'd like to step away from the tech for just the barest of moments to talk a little bit more about the thing that drives a lot of what happens in technology, and that's finance and funding. We're going to talk a little bit about the coming crunch in the IT industry and why I think that's actually going to be happening in some ways that we can potentially avoid it. Now, before I get started, I just want to let everybody know that I don't work in finance. I don't work around any kind of investment opportunities. So definitely don't take anything that I say as investment advice in any shape or form. I do have a degree in business administration, so I have had finance classes. I mostly understand how it works, but don't ask me to do your accounting either because, well, there's a reason why I got into tech. So let's just start at the basics, right? So what does it take for a business to stay in business? Well, it takes money. I mean, most people don't start a business out of the goodness of their own hearts. They do it because they want to make money. And in order for that to happen, you have to offer something. Historically, that's been an object or a device or something that people pay for. There are a lot of businesses now that operate on the service model. Think about a value-added reseller. We'll sell you things, but we really make more money off of the fact that we have our people come to put it in for you or provide some kind of expert analysis or something like that. So working off that basic premise that you need to make money in order to stay in business and you need to offer something that allows people to pay you for it, let's dive in. If you have something that you make that you are going to use to make money, you have to make the thing, right? We're going to throw the value-added resellers out of the conversation for just a moment because they are effectively using services on top of things other people make. So let's imagine, a widget, which is your historical term for a thing that is pretty generic. You have to develop this widget, right? You have to have an idea for how it works and you have to be able to build it. Well, that's not free either. You have to invest money in how that works. And historically, the way that you did that was you put your own money into it. I can't tell you the number of companies that you can look up on Wikipedia that are referenced and bootstrapped, which is the term for doing it yourself, pulling yourself up by your own bootstraps, by themselves. Think about a company like, Hewlett-Packard or Apple. It was built in a garage. The technology was put together by a group of people who really wanted to see it succeed. They invested their money in the company and voila, we have a thing. Modern startups don't do it that way. Modern startups have an idea. I want to build this widget. And then they need to build it. But because of the complexity involved in a lot of current technology, you can't really do that yourself, or you can't build it to the scale you'd like it to be if you're trying to build it yourself. So how do you get around that? Well, you need to hire people. Well, what are you going to pay them with? Well, you do need to pay them a salary. They do have to, eat and be able to afford a home and a car and many other things. So you have to get money from somewhere. Well, where does that money usually come from if you're not paying for it for yourself? Well, generally it comes from an investor, someone who would like to give you some resources, in this case, money, and in return, they would like to get a percentage of your business. They would like to be a part owner. Now, if you've ever watched a show like Dragon's Den or Shark Tank, you kind of know how this works. You've got a bunch of people with money, and you've got these people with ideas that are wanting to come in, and they're wanting the sharks or the dragons or what other predatory animal you can think of to give them money in exchange for ownership of the company, right? Makes total sense. In the finance circles, this is called an angel investor or possibly a seed investor or a seed round. Angel investor meaning they've descended on high and there's choirs singing and they've answered all of your prayers for needing money. Seed investing meaning it's a small seed that you plant and then it grows into something bigger, right? And there's a lot of symbolism here. So these people usually come in and they give you a set amount of money based on your pitch, and then you take that money and you use it to acquire the resources that you need to make things happen. Now, this could be hiring people to work. This could be acquiring assets like, a laptop or a software program. Could be buying a building or renting building space for people to work in. The point is that they've given you money. Now, what they're expecting in return is a return on that investment, just like any investor would. Now, that return could be a percentage of your company and the profits that come from it. It could be a return when their ownership shares are liquidated, which of course is the term for what happens whenever you get bought or you go public on the stock market in an initial public offering called an IPO. All right, so that pretty much makes sense. I have an idea. I want to build it. I ask somebody to give me money, basically a loan, and in return, I will repay that loan when I'm able, either through profits or through a payout when I am liquidated. Okay, that mostly makes sense, right? Angel funding and seed funding is fairly common in the startup space. But what happens when I need more money? Because eventually I'm going to run out, right? And so the term for that is the runway. How much time can I get for the money that I have? Obviously, if you get a specific amount of money, then you can hire a certain number of people for a certain amount of time for that. Fewer people I hire, the longer the runway, but the more time it's going to take me for development. Well, eventually you're going to want to get more money. The thing is, though, that you are not going to want to get it from one or two people. What you want to do is you want to open things up to allow multiple people to invest. Angel investors are typically looking for the next big thing. They're looking for a huge payoff eventually down the road. Whereas institutional investors, which would be funds that are named and collectivized, are looking more along the lines of receiving a trickle of income. And so what they'll do is they will pool their resources together and they will put funding behind a project, but not like a seed fund where, I'm going to give you $1 million, but I own half of your company. Instead, these series investors will get together and I'll open up a round and I will say, my company is worth this amount of money. Or the investors will say, well, your company is worth this amount of money, so we're going to give you an investment based on that with the expectation that you'll pay us off eventually. And these series are all named after letters of the alphabet. So the very first series funding round you take is A, then B, then C, and so on. And these can require a lot of effort because you have to show the work that you've been doing. You have to convince people to take part in this series round, and you have to keep track of how much they invested so you know how much that you owe them when everything is done. That makes sense so far, right? Well, sometimes when you have investors involved, it complicates matters a little bit. So if it's just you and your development team, you have this idea for the way that the product needs to work, right? And so you're going to build it according to those specifications. And if you run into a problem, you're going to work around it. And maybe that problem is going to take a little longer than you expected, so you have to work a little harder on it. But when you have other people who are helping, giving advice, or protecting their investment, they may put more restrictions on things. So for example, when you take a series round, it could be a requirement of the series round that you do certain things. Perhaps it is you have to have an actual product built. You can't just give us an idea. We need to see what you're trying to do. It could be that we want to change the design of this product because we realize that what you were trying to build originally isn't really going to sell or sell well. And what we want is something, as an investor, what we want is something that is a little bit more marketable. Instead of trying to boil the ocean and build the biggest, baddest, whatever it is, maybe you need to focus on making a smaller version of it that will actually sell before you expand. It's that minimum viable product kind of idea. It could be that the investors just want to be able to be paid out first in the event of a liquidation of some kind. So I'll give you money and I'm not going to put any restrictions on what you're going to do, but of all the people in this series round, I expect to be paid out first because I didn't put any restrictions on it. And the restrictions can go almost as far as, I'm going to give you this money, but I don't want you to run the company anymore because maybe you're just an idealist or you're not really good at managing the business aspect of it. So I want you to hire this person who I recommend to run your company while you focus on the engineering challenges. Those things have happened and continue to happen in the space. And that's a requirement of how you make your money. Because the other way is to build a business that makes money and continues to make money. If you're bringing in revenue and paying out all your expenses, The money is yours to do with as you wish if you are the sole owner or if you are a part of an ownership group. You can do whatever you'd like. Obviously, you still have to pay taxes on it, but you can invest in people, you can invest in expanding lines of business, you can do lots of things. But when the investors are involved, they all have a say. And the more investors you have, the more people you have trying to have a say in what goes on. So why do people do this? Well, I've alluded to it already, but they're looking to get paid. Remember, people don't get into business unless they want to make money. Investors don't invest in business unless they want to make money. If you think about the most basic thing that people can do when it comes to investment, that's a loan. I'm going to loan you $100. Well, how do you repay me? You repay me with interest. Here's your $100 plus interest as a thank you for giving me the money that I did something with. Well, in other circles, that interest takes the form of ownership or stock options or things like that. And it's really funny that interest comes up in this part of the conversation. Because when you look at historically the amount of investment that's been happening in startup companies for the last few years, you'll also notice that it tracks with something else: extremely low interest rates. The interest rate on borrowing is set by the federal government. It is looked at every few months, and the Federal Reserve Bank decides whether or not they are going to adjust the rate that other banks must be charged in order to borrow money. That interest rate, the prime rate, is what most banks will base their interest rates on. And so if the prime rate is low, 1 or 2%, and a bank adds on their own charge, then that is the amount of money that it would take for you to borrow from the bank. And the bank is an investor just like anybody else. They're just a little bit more formalized because they have their assets that they must keep on hold by federal government regulation. And so they actually will charge interest to you in order for you to make that money. Whereas in the financial investor market, they don't charge interest per se. Their interest charges are, stake in the company or things like that. Those historically low interest rates from the US federal government have driven a lot of the investment that you see in startups. Why is that? Well, money has an opportunity cost, and I don't want to go into the opportunity present value of money calculation because that literally is college level finance. But effectively, a dollar is worth more today than a dollar in 30 days because I can invest that dollar to earn interest, and in 30 days, I will have $1.02, for example. So it's technically worth more money to me now. Well, in that case, why are financial investors putting their money into a company? Well, they're looking at it as an investment, and they're weighing it against all of the other investments that are out there. For example, if I have $1 million laying around, literally doing nothing, sitting underneath my mattress, then in 30 days, I'll have $1 million. But if I take that $1 million and I invest it in a company, then there's the potential for me to make more than $1 million. But in the meantime, my $1 million is tied up in this company. Well, what are my alternatives? Well, in a lot of cases, they're financial instruments like stocks or bonds. Bonds are actually a really good reference here because they're relatively safe, comparatively speaking, because they have a small interest rate attached to them and they will eventually pay off at their maturity. That means that they're backed by certain organizations, whether they're the government or large companies, and they will pay off. But they don't pay off a lot. It could be that it's 3 or 4%. Yeah, 3 or 4% on $1 million is a lot of money to someone who is, not a millionaire. But for someone who is a millionaire, 3 or 4% is a safe investment. I'm going to get paid that no matter what. That's my default. But what if I could make more? What if my payoff was a multiple instead of a percentage? What if I could invest my $1 million and make 2 or 10? And that's the value of startup investment to these investors. So for the angel investors, they're investing money that they have laying around with the hope that in a few years, when that company goes public on the stock market or is acquired by another company, that their ownership stake gets paid out at a very high rate. You've probably heard the term unicorn, which is a company that has taken a significant amount of investment but has a very high valuation. And the idea is that if the company sells for what their valuation is, the people who have invested in the company will make a return on their money. Now, remember I told you that there's an opportunity cost, right? So money that's just sitting around doing nothing is really doing nothing for me at all. And in a market of historically low interest rates, money is effectively sitting around doing nothing. Earning 2% on my money isn't much at all, because I'm not looking to make a few $1,000s on my million. I'm looking to make hundreds of thousands or millions on my million. And if that doesn't sound a little bit like gambling, well, you're starting to pick up on how some seed round investors and how some angel investors look at these investments. They look at it like a slot machine. I'm going to put my money in and I'm going to pull the handle. But I'm not just going to put my money into one slot machine. I'm going to put my money into several. One of them should pay off if I've done my research. And you know what? If one of them doesn't, that's just the cost of doing business. That is an expense for me putting my money to work. And so a lot of angel investors have done the work of putting money into these companies, knowing that some of their bets aren't going to pay off. So what do they want to do? They want one of them to pay off so that they can take their million, maybe lose 250,000 in bad investments, but gain back 2 million. Now they have more money to invest down the road. But that means that the money has to pay off somehow, right? And that's the other side of the unicorn discussion. They have high valuations, but do they make money? Well, some unicorns take in a lot of money. Some unicorns have very big sales numbers, but they don't generate a lot of revenue. For those of you out there that didn't take accounting, that's a really easy conversation to have. The amount of money that you take in, your gross revenue, minus all of your expenses, is your net revenue or your net profit, right? Makes sense. I take all the money, I pay what I need to pay, and what's left over is the money that I make. Would you be shocked to learn that a lot of companies in the space don't actually make any money? Go look at the financial reports for a lot of technology companies out there. They have really big sales numbers. They have really big gross revenue numbers. But when you account for all of the expenses that they have, whether it's their labor costs or their costs of goods sold, which is the inventory that they are required to hold and sell, they actually lose money every quarter. Well, when I was growing up, my mom told me that if your business doesn't make money, it won't be a business for much longer. How do they continue to make money? Well, that's easy. They grow. They add products. They add customers. They keep moving forward. If you are shocked at the fact that technology companies are graded as much on their growth potential as on how much money they make, you probably would not do well in finance, because, as I've learned over the years, common sense sometimes does not have a place in the finance world. They're hoping that the company gets big enough that they'll eventually make money, or they get to a point where they can get acquired to become a new line of business for an even bigger company. Little fish in a big sea. And then they'll get paid. But something is changing in the market. The first thing that's changing is that the costs of doing business are going up. You probably know this as inflation. And again, I don't want to get into college level economics, but essentially what's happening is that there's a lot more money in the market, which means the costs of buying things are going up because suppliers can charge more. Well, that means that all of those costs are being passed along to everybody else, which means it's taking more money to operate businesses than it did before. And that means that people are starting to look at how much money they're putting into these things for the amount of return that they're getting. The second thing is actually one of the ways that the federal bank combats inflation. They raise interest rates. They cool the market. It costs more money to borrow. Remember how I told you that angel investors and seed investors spend a lot of their own money? When interest rates are historically low, and you know that you could take out a loan from a bank and pay it back handily, why would you risk your own money when you can risk somebody else's? And so historically low interest rates have led to a situation where a lot of people are investing a lot of money hoping that one of those slot machine pulls pays off in time for them to pay back the loan. But as soon as the interest rates start going up, two things happen. One, it costs more money to borrow money from other people. That's the nature of the beast. But the second thing is that banks start paying more interest on your capital that's just lying around. In the industry, that's called dry powder, probably because you sprinkle it on things and it makes it taste better. So if you're dry powder, if your unallocated capital is just lying around and suddenly the Fed raises their interest rates 2 points, well, then that means that the baseline interest earning of your capital just went up 2 points, which means your calculations all changed, which means you have to decide if you want to invest another round into people or if you just want to keep it where it's at and wait for something else better to come along. So now investors are being much more specific about what they want to invest in. And that means they're going to start setting more and more conditions. You need to keep your head count under a certain amount. You need to have a better thought out idea with an actual prototype before you come to me for your funding. Or you need to actually make money. And that's one of the things we're starting to hear from many investors that are kind of in the background telling the companies that have been going to them for investment, you actually need to make the company run on the investment that you already have. You need to turn a profit before I'm ready to put more money into you. Mostly because a profitable company has a sound business strategy with good product mix and is more than capable of being a good acquisition target. Now, you've probably seen a lot of companies that are getting acquired or purchased, and usually there's a dollar amount that's attached to them. Oh, this company was bought for $50 million or $100 million. Well, remember that the companies that are invested in by these investment firms or these angel investors are going to have to pay a portion of that to whomever invested when they get bought. But what about those companies that don't publish their purchase price, for example? Well, they're not required to by federal law if the amount of money that the buying company spent, it's not a material impact on their required filings. Basically, it was so small, I didn't have to report it. Well, in those cases, it could be that the company that was acquired, their investors basically forced them to sell the company to recoup that investment. Think of like the clearance rack at your local department store. These things aren't selling, and we're definitely not going to make as much money as we'd hoped, but it's still costing us money to have them in the store for inventory purposes. We need to get rid of them. So it's better for us to sell them for whatever we can get for it than it is to keep it around in the hopes that somebody eventually down the road might buy it for what we think it's worth. And that's where we get into the mess of a lot of companies that are starting to make themselves more attractive for acquisition by doing things like laying off labor. Why? Well, labor is a very big percentage of the amount of money that is spent. In an average company, numbers say that labor costs can be 25% of your actual expenses. If you're more focused and oriented on services, that could be as high as 50%. So you need to reduce your labor costs in order to make yourself a more attractive acquisition target. Or at the very least, you need to reduce your labor costs to make sure you're making money. Now, some organizations, they categorize their labor very differently. Anything that is actively in the process of earning the company money is very important. Things like sales, things like accounting. IT, on the other hand, is normally seen as something that costs the company money. You probably heard IT referred to as a cost center. Well, if you are someone who works on the back end, if you're not actively maintaining the infrastructure and providing revenue for the company, your job could be on the chopping block. It's also a whole lot easier in a market where there are a lot of available jobs in a very small pool of people, because I can try to make that job look more appealing to people who want to get hired, but I can also reduce my staffing costs knowing that there are jobs out there for people to take. It maybe is a little less heartless to let someone go when I know that there's a lot of jobs. And if I'm really looking for specific talent, maybe I can add some sweeteners into the deal to get them to want to come to work for me. So when you add up the fact that there's a lot of investment that's sitting out there right now that's not being allocated because investors are taking a wait and see approach to see what's going to happen with the economy, and when you have a lot of companies that are very focused on growth but not so much on making money, and you have a very hot job market because there's a lot of open positions, it leads to what could be considered a problem coming for tech. Because investors think that tech stocks are overvalued, so they're starting to correct them, which means they're selling them off, which is reducing the amount of available cap space. So right now, companies are starting to look less valuable than they had in the past, which means they don't have as much money as they did before to invest in growing their lines of business, which means their growth is slowing, which of course leads to the cycle of investors not thinking they're very valuable anymore, which means they're going to have to do things to look more valuable, and that includes cutting costs. And costs in almost all cases in tech companies are jobs. So that's what you're going to be facing as you start looking at the job market. You've probably already heard from your friends that they're starting to have job cuts or that they're moving on to new opportunities or something like that. So keep that in mind as you start looking. And if you're someone that's coming directly out of college, you need to remember that a lot of the places that you're going to work, you need to think about what you're going to be earning and what you're going to be learning while you're there. If you walk out of college thinking you're going to make $185,000 in the middle of nowhere, working remotely, doing coding 12 and a half hours a day, you're going to need to reset your expectations, because a lot of companies are starting to have to reset their expectations too. That'll just about do it for this episode of Tomversations. I hope that you guys had fun looking at a little bit of the dirty back end of the way that companies work, because unfortunately money is the driver that makes this all happen. But it should give you some ideas about what people that are not in tech in the IT area of your company have to think about on a daily basis. And if you'd like to hear more about this, you can always check out our website at gestaltit.com. We have a variety of opportunities to learn about this through our weekly rundown, where we talk a lot about companies making money and then getting acquired. Our Checksum series, where we talk a little bit more deeply about specific topics in the news. And of course, all of the great coverage that we get from our community. I should be back again next month with another great episode, and I hope that I will see you then.